Let's clear up a huge myth that catches a lot of new investors off guard. Despite what you might have heard, crypto is not a tax-free playground or a loophole to avoid taxes. The IRS treats crypto as property, not currency, and they're watching closely, just like they do with stocks or real estate. If you don't report your gains, you risk massive fines, penalties, or even legal trouble. The consequences can be severe. Every time you sell, trade, or use crypto, even to buy a coffee, it's a taxable event, just like selling stocks or other investments. The IRS works with exchanges, tracks blockchain transactions, and uses advanced technology to spot unreported profits, so hiding gains is a fantasy. Treat your crypto like any other investment. Track your gains, keep detailed records, report them accurately, and pay what you owe. Ignoring these rules can turn a profitable year into a financial nightmare, with unexpected bills and stress. Learn the basics of crypto taxes now, and you'll save yourself a lot of stress, confusion, and money in the future. Remember, a little knowledge and preparation goes a long way when it comes to crypto and taxes.
In crypto, a transaction is more than just buying or selling. It's any action that changes your ownership or control over digital assets, and it can happen in ways you might not expect. Anytime you dispose of crypto, selling, trading, spending, or even gifting, it's a taxable event. The IRS considers these moments as points where you realize gains or losses, so they're important to track. Trading Bitcoin for Ethereum? That's a transaction, and yes, it's taxable. Even if you never convert to dollars, swapping one coin for another still counts. Buying coffee with Dogecoin? That's another taxable event. Using crypto to pay for goods or services is treated just like selling it. Even sending crypto to a friend or earning it as payment for your work counts as a transaction. These actions can create tax obligations even if you're just helping someone out or getting paid for a gig. Activities like staking, mining, or providing liquidity are all transactions in the IRS's eyes. Earning new coins or rewards through these methods is considered income and needs to be reported. Each event has a date, value, and tax consequence you must track. Keeping records of when and how much you transacted is crucial for accurate reporting. The key, almost any movement of your digital assets could trigger taxes. Even small transfers or swaps can have tax implications, so don't overlook them. Don't just focus on cashing out. Track every exchange, trade, or use. Staying on top of your records now will save you headaches later. Awareness is your first defense. Understanding what counts as a transaction helps you avoid surprises at tax time. Once you know what counts, you can build a system to stay organized and make tax season much less stressful.
Let's break down the main taxable events that every crypto user needs to know. Understanding these can help you avoid trouble with the IRS and keep your finances in order. Selling crypto for cash? You owe capital gains tax on the profit, just like you would with stocks or other investments. The difference between what you paid and what you sold for is what gets taxed. Trading one coin for another? That's a taxable event, even if you never touch dollars. Swapping Bitcoin for Ethereum, for example, means you have to calculate your gain or loss at the time of the trade. Earned crypto, through work, mining, staking, or airdrops, is taxed as income at its fair market value when received. This means you need to record the value in dollars the moment it hits your wallet, no matter how you earned it. Later, when you sell or trade that earned crypto, you'll pay capital gains on any increase in value since you first received it. So, you could be taxed twice, once as income and again on the gain. Even using crypto to buy things, like pizza or coffee, counts as a sale, and you owe tax on any gain. Every time you spend crypto, you trigger a taxable event. Every transaction, big or small, can have tax consequences. Even micro purchases add up and need to be reported. This is why using crypto for everyday purchases can be a headache. The paperwork and tracking can quickly become overwhelming if you're not organized. Each purchase is a mini sale you need to track, record, and calculate gains or losses for. Missing even a few can throw off your tax return. The IRS expects you to report all of it, no matter how small the transaction. They're paying close attention to crypto activity these days. Missing these events can lead to costly mistakes, penalties, or even audits. It's not worth the risk to ignore your crypto transactions. Stay vigilant and document everything. Good records are your best defense if questions ever come up. It's the only way to avoid surprises at tax time and keep your crypto journey stress-free.
So, how do you keep track of all this? Meticulous records. For every transaction, log the date, type of crypto, amount, and value in US dollars. Don't rely solely on exchanges. They can miss key details. Use crypto tax software to import transactions and calculate gains and losses. Still, keep your own backup records, even a simple spreadsheet. Download your transaction histories from every exchange regularly. Store your data safely, cloud and hard drive. Good records are your best defense if the IRS comes knocking. Organization now saves you headaches later.
Don't wait until tax season. Plan year-round. Use tax loss harvesting. Sell losing coins to offset gains and lower your bill. Hold assets over a year for lower long-term capital gains rates. Patience can save you serious money. If your crypto activity is complex, hire a tax pro who knows crypto. Their advice can save you more than their fee. Always be honest. Underreporting is risky, and the IRS is getting smarter. Use the right tools, track everything, and apply smart strategies. Understanding crypto taxes makes you a better investor. Play by the rules, and you'll win in the long run.